I created Celsius because I believe that we have to have a company that basically puts a community first and creates a community.
These are the words of Alex Mashinsky, the founder and CEO of Celsius Network, a leading crypto lender that filed for bankruptcy in July 2022 after suspending withdrawals. Celsius is also known as a Cefi platform, a fairly new type of financial player mixing centralized and decentralized finance, or DeFi. There's an interface that looks like a regular app, but it's operating in DeFi to generate returns and yields. Mashinsky spoke a lot about the community.
Unlike banks that do that and keep all the profit to themselves, in the crypto world, we give most of the profits or most of the yield back to the community.
Today, the 1.7 million users of Celsius are no longer known as community members. They are unsecured creditors facing Celsius in court, and it looks unlikely that they will recover their funds, at least not in full. Celsius is not an isolated case. Other CeFi platforms such as Voyager, Babel, BlockFi, or Vault run into similar trouble at the same time, and they're all at different stages of life support as we record this. The amounts are significant, probably tens of billions of dollars, but what's really unique about this event is that people's savings are at risk. During the great financial crisis of 2007-8, the savings were in the banks, and banks were bailed out. It won't happen here. How did it go so wrong? This is what we're trying to find out in this first episode about Cefi. Hey, quick note, this is George. I normally host interviews with fintech and crypto founders, but I wanted to give a new direction to the podcast. This is the first episode of a documentary series about Cefi. It's a format that allows me to go more in depth and to really put together many of the elements gathered through previous interviews. And because Cefi involves both crypto and traditional finance, it really offers a glimpse into the future of investing, or, in this case, what we don't want the future to look like. Now back to Celsius.
This synthetic voice will be used to read Celsius statements, like this one from the website, because we put our community first. Military-grade security, next-level transparency, and a do-it-all app to help you reach your financial goals.
That's a value proposition you can still read on the Celsius website. The grammar might be a bit strange, but it's clear. It's about security, transparency, and convenience, but also double-digit yields on, for example, US dollar-pegged tokens. And this is really what made it irresistible. Before its collapse, people could expect to make up to 18% on Celsius. The rise of Celsius is spectacular, but the assets only came later. It was launched in 2018, raising $15 million through an ICO, initial coin offering, which were later banned, and by the end of that year, it had about $50 million of crypto transferred onto its platform by users, mainly individual investors. By May 2019, that number grew to 200 million. By 2020, it had reached over $1 billion. Let's hear it from the Celsius team.
So looking back at January of 2020, we were very proud of what we achieved back then. But the growth and the expansion of Celsius over 2020 was nothing further than epic, nothing further than historical.
Then it really took off.
Progress we've made in 2020 has positioned us tremendously for 2021. This is the year of crypto.
By March of 2021, assets had grown to more than 10 billion, and it reached above $20 billion in assets at some point in 2020. But after the Terra collapse in May 2022, followed by the fall of Three Arrows Capital, a hedge fund that was transacting with Celsius, the withdrawals began. The Celsius bankruptcy filing offers transparency into an industry that's otherwise very opaque. It reveals that the company now has $4.3 billion in assets set against liabilities of $5.5 billion, of which $4.7 billion is owed to its user. Now, before going deeper into the filing, I just want to look at the headline stories. For many outlets, it's this 1.2 billion deficit, the difference between 5.5 and 4.3. And it's a scary number. However, some details make it look optimistic. The assets include 720 million in mining assets. Unlike a traditional mining companies with excavators and machinery, Celsius assets are probably computers and rigs used for Bitcoin or other type of mining. These depreciate fast, and they're actually currently going at discounted prices. So the 720 million figure is in doubt. There's also the CEL token, the Celsius native token.
Or about half of our users have said, I don't want Bitcoin, I want you to pay me in CEL token. So we have to go to market and buy CEL tokens. If we have more users, more loans, more earnings, we have to buy more CEL token. That impacts the price of CEL. More buyers versus more sellers means that the price is going up or is going to go up.
There are 600 million in assets and 210 liabilities in CEL. Remember when we said Celsius raised $15 million in its ICO? The net CEL exposure is around 390 million. And that's assets.
And that's all the utilities that allow people to earn more using the CEL token also translate to more demand of CEL token, because when somebody is platinum and they earn 35% more than they would have earned if they just earned Bitcoin on Bitcoin, that means we have to buy 35% more CEL token in the market. And by doing so, we are putting much more buying demand.
But how much is that really worth if there's no utility for CEL outside the Celsius network? And if they had to sell that to pay other debts, what would the selling pressure do to the price? So here's another 390 million at risk. There are more assets, including crypto tokens, that don't look too solid. But my point is that this figure of 1.2 billion deficit, which appears so scary, may still be optimistic. Now it's time to zoom in and look at what went wrong and how it happened. In the report, we read,
The company made what, in hindsight, proved to be certain poor asset deployment decisions.
So what do we know about Celsius' poor asset deployment? The basic business model was providing high guaranteed yield on various assets.
Celsius helps over 1 million customers worldwide to find the path towards financial independence through a compounding yield service and instant low-cost loans accessible via a web and mobile app.
Users could transfer their crypto asset to Celsius, and then they could borrow against it, but mainly they would earn rewards, earn yields.
We've been saying now for 3 years that it's all about yield.
And to achieve returns, here is the list of activities as provided by Celsius in its Chapter 11 filing.
Lending to institutional clients, lending on DeFi protocols.
Let's pause here. Lending is where you'd expect the list to stop for a company that's actually a lender. And a typical risk for lenders would be asset and liability mismatch, because loans are typically short-term while funding is long-term, and lenders manage that. But the list goes on. Celsius was no ordinary lender.
Staking, swing trading, funding, cash and carry, market making, spot trading.
It does sound a bit like an episode of Billions.
We are open to all money-making ideas. Longs, shorts, sells, covers, all alpha welcome.
So let's just go through a few items of the list, starting with lending to institutional clients. It means it was lending to hedge funds like Three Arrows Capital, an activity that's very similar to the prime brokerage desks of investment banks in traditional finance.
On the institutional side, we have very credible counterparties. They have billions of dollars in a balance sheet, and for those, we have under-collateralized, but we don't offer any non-collateralized loans.
But the loans were only about 50% collateralized on average. And that will become a major factor in the $1.2 billion gap that we found in the filings.
Are you comfortable with the risks involved in that for the business?
Yeah, look, we've been doing this for 5 years now, longer than anybody else.
Some of the activities are well known, such as staking. In fact, staked Ethereum is one of the most crowded strategies. It was used by Celsius, by its hedge fund clients, and by a crowd of retail investors. Cash and carry is another fairly well-known arbitrage strategy.
This strategy involves Celsius trading and leveraging demand in the futures markets to benefit from the funding costs that long futures holders were willing to pay short holders.
And it's just as crowded. For the rest, such as market making, swing trading, spot trading, the Celsius definition is less clear to me. Take swing trading.
Similar to market making, this strategy involved Celsius holding both long and short futures positions, but with an imbalance between the amount of long and short options Celsius held.
It's not exactly what I expected. Swing trading is generally a kind of momentum strategy. And when listening to Mashinsky, maybe I'm not the only one confused.
When Bitcoin is going down, there's actually more demand for Bitcoin because market makers, again, are either they need a lot of stable coins or they need Bitcoin. Normally, they need a lot of stable coins when Bitcoin's going up. They need a lot of Bitcoin when Bitcoin's going down. Why? Because they do more aggressive market making or arbitrage, or more people are interested in shorting Bitcoin. To short Bitcoin, you need to borrow Bitcoin. So Celsius doesn't care, again, if markets are going up or down.
We keep hearing that Celsius doesn't care about the market's direction, yet we read in the document that it was involved in trading, mainly taking long positions on tokens.
Because you, the user, you, the Celsius customer, are taking the risk. You're willing to wait several years and basically be part of the community, right? Hodl on. And in return, we are monetizing the fact that you are long-term.
Yes, the user should hodl, but in summary, there was lending that was under-collateralized, arbitrage or market-neutral strategies that were often crowded, and then trading, mainly long positions. This is a dangerous mix. When it comes to the origins of the problem, Celsius points to the rapid growth in assets during 2021.
The amount of digital assets on the company's platform grew faster than the company was prepared to deploy.
That's a familiar challenge to the investment industry. Large inflows usually affect performance negatively, but again, Celsius was not meant to operate like an investment manager, where the net asset value can fluctuate. It presented itself as a lender, and its focus was on growth, so it never considered restricting inflows or lowering yields. The only option left was to increase its source of risk and the size of its positions. The company describes the market conditions that led to its downfall as the crypto-apocalypse, and it names 4 horsemen. First, the collapse of the Luna chain in May 2022.
The Luna collapse erased approximately $40 billion of value and contributed to further sell-offs in the cryptocurrency sector. Many projects and funds which relied on us as a stablecoin saw their treasury wiped out.
Second, the domino effect or the aftermath of Luna, which includes the collapse of Three Arrows Capital, 3AC, a debitor of Celsius.
The collapse of Luna had a significant effect on the cryptocurrency industry. Many cryptocurrency-focused hedge funds and other cryptocurrency companies held Luna and incurred losses on their position after they sold.
Then there's the depegging of liquid staked Ethereum. It's a very common way to get part of the yield associated with staking Ethereum, but depegging is actually not the right term because this is not something pegged. They're 2 independent tokens that should evolve in parallel, but the prices can vary depending on supply and demand. And the fourth one is misleading media coverage.
As Celsius attempted to weather the cryptopocalypse storm, it began to receive increased negative media attention. A number of such stories were false and misleading. Immediately after the Luna collapse, social media spread misinformation regarding a commitment by Celsius and others to a possible Luna bailout. followed by statements that Celsius had lost hundreds of millions of dollars on Luna.
We could call that a crypto bear market, and it was accelerated by the problems at Terra. But despite those market conditions, most protocols that provide these sources of yield, such as lending, staking, trading, they've continued working fine, and including those where Celsius was operating and held large positions. They're the same protocols that Celsius aimed to protect its users from.
So what Celsius does very well is review all these opportunities, figure out which ones are safe, deploy assets on your behalf, and again, give you up to 80% of that value.
Mashinsky is clearly dissing the DeFi ecosystem of financial application based on the blockchain.
Where again, if you did all that yourself, yes, you can earn 100%, but when you deduct the transaction fees and the gas fees and the risk that you're taking and getting wiped out.
So this is where there's a clear dissonance between the message that Celsius is pushing in the bankruptcy filing and the reality of the markets in DeFi. And actually, DeFi got the last word. The final move of Celsius before filing for bankruptcy was to repay the loan to the DeFi lenders, such as Aave and Compound, to avoid any liquidation and reclaim collateral. Because of their non-negotiable nature governed by smart contracts, those DeFi lenders were actually better protected than other lenders, including Celsius users. The latter have to go through this bankruptcy procedure.
I think you are always going to end up ahead by doing it through Celsius than doing it yourself.
If anything, it looks like DeFi, through this crisis, has proven its solidity as an alternate financial system. And the irony is that DeFi delivers some of the features that Celsius advocates on its website, but never implemented.
Next level transparency.
The activity on-chain is fully available for anyone to scrutinize. So it's hard to have nasty surprises.
Military-grade security.
DeFi protocols are non-custodial, meaning that if they collapse, users should still be able to retrieve their funds. Allow me to use a bit of Greek to try to understand what this apocalypse really means. Apocalypse, from the Greek apo plus calypsis, literally means uncovering, or in other words, a sort of revelation. It's a catastrophic event, but it's also a revelation about the true nature of Celsius and the Cefi industry. As a lender, it had terrible risk management practices, but its true nature was actually not that of a lender. It was operating like a hedge fund. So there's a mismatch between the product, which is guaranteed yield on tokens, and the activities, prime brokerage, arbitrage, trading. Finally, while it was claiming to protect users from the risk of DeFi, it turns out that DeFi was safer. Celsius chose the name Apocalypse to blame events of a catastrophic scale, but crypto has in fact functioned normally despite the bear market. A better definition could be something like an investment vehicle seeking absolute returns through on-chain activities while aiming, but not guaranteeing, to preserve capital. That might be more truthful, but a lot less appealing than the way Celsius presented itself. It would definitely not have attracted so much venture capital money, and it would never have gathered the billions of dollars of customer assets that it did. Before we wrap up, I want to add that there could be an even darker side of the story. A research outlet called Arkham pointed out that Mashinsky, the CEO, could have been a seller of Cell token in a suspicious way while he was declaring that he was buying in the late days of Celsius. Regulators are investigating the account freeze. It looks like Celsius has been encouraging inflows while knowing it was insolvent. And that makes it look like a Ponzi scheme. Maybe that's what it was all along. Something you can read between the lines in the filing document.
During this period of extensive growth, The inflow of digital assets onto Celsius platform outpaced withdrawals.
A Ponzi scheme is an investment fraud that pays existing investors with funds collected from new investors. Celsius was fine until there were withdrawals. Some final words about what Celsius teaches us about Cefi in general. For a while, they seem to deliver on two promises: yield and convenience. But Cefi always failed on the other two, security and transparency. And everyone was doing similar things. Cefi is not dead. BlockFi, for example, has not suspended withdrawals and has secured a lifeline from FTX. But with the benefits of hindsight, it's a business model that doesn't look sustainable. Yet just a few months ago, in early 2022, when the stock market started to crash, when bond markets fell as well, and we knew less about Cefi, it looked like a very attractive proposition. Yield and non-correlation with the rest of the markets. The next episode will examine how Cefi could be so successful. What made millions of people, and not just crypto fanatics, trust high-risk crypto startups with their hard-earned cash? Now, if you want to understand more about the strategies that many of those players, such as the crypto hedge funds, are using, please take a look at the course that's linked below. It goes through the market-neutral strategies, and what's unique about DeFi is that all players have the same access to those strategies. They are useful for investors to understand, but also to use the proper risk control measures in place. Thanks for listening, and stay tuned for the second episode of the series.